Hello everyone, I'm Vincent Andreacchi, VP of Business Development here at ISG Transportation. Welcome to our January 2026 market update for LTL and full truckload in North America. As we move deeper into the new year, the market shows early signs of tightening capacity amid post-holiday adjustments, winter weather disruptions, and ongoing policy uncertainties. Volumes remain soft seasonally, but spot rates are holding firmer than expected, with tender rejections elevated. Here's a breakdown by segment. The Canadian trucking market remains relatively muted compared to the US, with domestic demand softened by seasonal factors and lingering trade policy uncertainty. Domestic Canadian truckload tender rejection rates remain relatively low and normalized compared to the US, often tracking 3 to 5% in recent periods. Road freight transport continues to grow modestly, with the market projected at around 43.87 billion USD in 2026 and a compound growth rate of just over 4% toward 2031. And it's mostly driven by e-commerce infrastructure upgrades and resource sectors. Let's talk about some LTL and full truckload trends. Domestic freight dominates, but international lanes, including cross-border, are accelerating faster. LTL holds steadier due to parcel and retail activity in key regions like Ontario and BC, while full truckload sees some stabilization with lower diesel prices, which average around 1.48 Canadian per litre. Cross-border flows, primarily between US and Canada, continue to navigate uneven demand, with automotive sector weakness, new tariffs effective January 1st, customs delays, and seasonal disruptions adding layers of complexity. Nearshoring momentum supports overall North American trade growth, but US-Canada dynamics show directional differences influenced by policy uncertainty and manufacturing trends. Volumes are expected to remain relatively stable into early 2026. Northbound, US to Canada, holds relatively firmer compared to southbound, supported by resilient non-automotive exports and some holiday-related restocking. However, tariff uncertainty on select goods like steel and autos and cautious inventory strategies in Canada contribute to muted activity in certain lanes. Rates have remained steady in many cases due to balanced equipment needs, though weather events and border scrutiny can cause some short-term tightness. Tender rejection rates hover around 7 to 8%. Southbound, Canada to the US, this direction faces more pronounced softness driven by weaker automotive volumes, reduced parts shipments for assembly, and exporters pausing amid ongoing trade policy concerns. This leads to challenges in trailer repositioning and more favorable pricing opportunities on southbound loads in some instances. Non-auto exports provide some stability, but overall, the direction sees greater instability in truck utilization and rates. Tender rejection sit around 2.5 to 4%. The US domestic market is showing more pronounced tightening in truckload, with capacity exiting slowly and spot rates elevated despite seasonal softness. Tender rejections remain high, around 9 to 10% nationally, and weather events continue to disrupt. Let's talk full truckload trends. Spot rates hold strong, around 2.62 per mile inclusive of fuel, and it's recently down from December peaks, but above 2025 levels. Spot pricing is outpacing contract in this environment, but it's a narrowing gap which signals upward pressure on 2026 contract renewals. Forecast for 2026, dry van spot rates are up 8% year over year, with reefer +6. Capacity tightens gradually, but overall exits are supporting firmer pricing. Let's talk LTL trends. The market stays soft with tonnage and volume declines, but mid-single-digit rate increases anticipated for 2026. As truckload tightens, smaller shipments migrate back to LTL networks. Let's talk key trends for 2026. The first, capacity tightening and rate firming. Excess capacity from prior years is absorbing, with driver shortages, regulatory pressures, such as CDL restrictions, and equipment order trends leading to gradual tightness. But expect modest rate increases, especially in truckload with Q1 seasonal dips, but upward pressure building mid-year. Weather also remains a wild card for some short-term disruptions. Let's talk the second key trend, US-Canadian exchange rate shifts and cross-border implications. The USD to CAD exchange rate has declined approximately 8 points year over year, from higher levels in early 2025 to current ranges around 1.37. This signals a relatively stronger Canadian dollar. For shippers with cross-border operations, this can benefit Canadian-based exporters by increasing USD-dominated revenue, which converts to Canadian, potentially improving margins on US-bound freight. It can also signal increased movements from the USA to Canada, with more Canadian companies willing to purchase from the USA given the cheaper exchange. However, it raises costs for US-based importers who purchase Canadian goods or services, which could pressure budgets and lead to tighter negotiations or volume adjustments. In a market with directional softness like southbound weakness, this currency dynamic adds another layer for optimizing lane strategies and potentially favoring more balanced flows or hedging against volatility. If these shifts are impacting your shipping, whether domestic, cross-border, or US domestic, ISG Transportation can help optimize with reliable LTL and full truckload solutions. Contact myself or one of our trusted sales reps via email or LinkedIn for a personalized strategy session, especially when it's related to your equipment needs. Looking forward to February's update. Stay safe on the roads.